Welcome back to Cheddar Business, everyone. Earlier this week, President Trump stood down on his threat of tariffs against Mexico, but almost simultaneously raised the idea of hitting China with even more. Yesterday, adding that he's the one holding up a trade deal. Joining us now is Seth Denson, president and co-founder of GDP Advisors. Seth, great to have you on the show.
Thanks for having me.
Why do you think the market is not reacting significantly to President Trump's $300 billion threat? Because in a previous life or a previous time, I'd say previous time, a year ago, 6 months ago, if the president would have said this, we would see major fluctuation of the U.S. indices.
Yeah, I think what the market has done is it's stabilized itself from the emotional aspect of what the president says or tweets or does. And so for that reason, I think investors are stepping back and saying, we're going to hold off until we see some actual movement in any action from the White House and the administration.
Because make no mistake, $300 billion in additional tariffs, or rather tariffs on $300 billion of additional goods, that is a significant move by the U.S., and that would significantly affect how much we pay as consumers for goods.
Absolutely. I mean, we see the CPI numbers coming out this morning, right? And the market really just is kind of holding stable as far as the consumer pricing index goes. That would have a significant impact to the cost of goods. You've got the big summit coming up at the end of the month. Obviously, President Trump is pushing for a meeting with President Xi. And I think that until that occurs and there's movement on that, I don't see the president moving forward with actually implementing these tariffs. And so for that reason, I think the market is recognizing that and stepping back.
When does the market, though, come to the realization that if President Trump is reelected 6 more years, we should anticipate trade wars and trade threats with not just China, but other nations, too?
Well, listen, if we learned anything from what just happened this past week with Mexico, is that the president is likely emboldened by the fact that the threat of the tariffs got him what he wanted. Now, many are arguing, Democrats specifically, that we were already at the goal line with that deal anyway, but the president pushed the ball across the goal and got the points.
And the New York Times, though, over the weekend with a big story essentially saying, hey, a lot of the stuff that was announced was previously agreed to before President Trump even threatened these tariffs.
Right, agreed to but not implemented. Again, I think that if we've learned something about this president, he likes the showmanship of getting to spike the ball. And again, if you're at the goal line and he pushes it through the goal, he's getting to spike the ball. So he is emboldened by this.
So what are the implications of that? What are the implications of President Trump using the threat of tariffs or tariffs as his preferred method of negotiation, even when it comes to matters that are not of the economy?
Well, listen, there's a massive threat.
Or trade, I should say.
Listen, tariffs are the biggest bully whip that the United States has in negotiating with foreign powers, right? We're not going to war over trade issues, but we can, because of our imports versus exports, we can move the market based on those things. That is a big, powerful stake. The challenge is we no longer live in a secluded economy. It's a global economy, and that ripple effect is felt across the markets, not just here or in China, but in Europe and all throughout Asia as well.
Let's discuss the inflation numbers this morning, coming in basically in line with expectations, but this has long been a concern in a lagging area of this economy. Do the inflation numbers concern you?
Well, they are a concern, especially when you consider where interest rates are. Obviously, the president is pushing to try to drop interest rates. That would be good for him coming into an election season, to be able to say, hey, the cost of goods are not going up and we're trying to influx more cash into the economy. That is a concern just because of the structure in which our economy isn't growing from a standpoint of how much money is in the market versus how many goods are available in the market. And that's going to impact commodity markets and things like that as well.
We've had a few days to digest the jobs number that came out from May. It was a massive miss in terms of jobs that were added. We had a little preview of that with the ADP numbers that came out a little earlier in the week, so it wasn't entirely unexpected, but it did change the way I think that traders thought about the Fed lowering interest rates for the remainder of the year. With the benefit of a few days to digest those numbers, how do you take that report into account?
Well, listen, I take it into account in a couple different ways. Job numbers may be down, but if you also look at other reports, wages are up. So we are in a great economy where joblessness is at an all-time low.
They are up, but they're not up as much as economists would expect, given how low unemployment is.
Well, no doubt, but you've got to understand that I think that, again, because cash is readily available with low interest rates, I think that the market is trying to adjust to that. and really trying to determine what's going to be happening in this next election cycle. This next election cycle will have a significant impact on what the economy does going forward. And with so many Democrats in the race, with President Trump obviously trying to figure out who's going to be the front runner, and ultimately it seems like we're already moving into a general election cycle, that's going to have ramifications, and I think everybody's just kind of stepping back and waiting instead of moving.
Does the Fed have its hands tied? That you look at inflation, you look at the disappointing jobs report that we had about a week ago, you look at President Trump being very vocal about wanting the Fed to cut rates.
Yeah.
Does it have an option? Does it have to cut rates this year?
I don't think it has to cut rates. Again, the economy is still thriving. It's still good. Job numbers may be down a little bit, but at an all-time high. Look at the markets today. They may be dropping a little bit in the moment, but they're fairly stable. I think that the Fed is really in a good position to make determinations on what they feel is best.
Before you go, how many rate cuts are we going to see at the end of the year?
I think no more than one or two.
No more than one or two. Seth Denson, president and co-founder of GDP Advisors. Thank you so much for joining us.
Thanks for having me on.